Guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Monday evening. It is November the 15th, which means it's also the middle of the month. And that means it's also the middle of the fourth quarter. And for most of the quarter, to date anyway, WTI has been hovering around the $80 mark. So the price of oil has been good. It's been strong. The question is, where is it going? And how do we look at the macro in order to ensure that we manage our investments to the best of our ability? So what I thought to do is take a quick roundup of the sort of macro thesis right now and sort of see what's going on and make sure everybody's up to date in terms of where we are and what is happening. So this little video here from oilmarkets.com.
Global gas prices, resurging air travel, and returning Asian demand could push Brent crude prices as high as $120 per barrel, Bank of America said this week, and they could push it this high as soon as the first quarter of next year. According to Bank of America, the U.S. may not be completely exposed to the natural gas crisis, but Europe and Asia are. This has led to some power providers switching from gas to oil, which has raised the demand for crude oil. Add to that a resurgence in international travel to the United States after the U.S. loosened restrictions for vaccinated travelers, along with what Bank of America calls supply rigidities, and you have a recipe for higher prices. When Bank of America talks about supply rigidities, it's talking about two main reasons for its perceived rigidity. The oil sector's terrible returns over the past 6 or 7 years that have made investors skittish, and an uncertain future of oil demand amid the much-discussed energy transition. At least some rigidity is apparent in the market as the United States continues to pump 1.6 million fewer barrels per day than it did prior to the COVID lockdowns. Other rigidity can be seen in some OPEC Plus producers that have failed to produce as much as their newly increased quotas allow. The United States has been quick to point fingers at OPEC Plus for the current high oil prices, which major oil consumers, Japan, India, and the United States, have loudly lamented. The United States insists that OPEC Plus does not care about the economic recovery. OPEC Plus, on the other hand, has been self-congratulatory, pointing out that without its role in managing the oil market, oil prices would be double where they are now, much like natural gas and coal.
Well, there's a lot to sort of unpack in that video there. So what I did was I spent a little bit of time kind of just going through the news media in order to see exactly what it is that's happening in the marketplace and maybe give you a quick overview of the macro thesis as it relates to energy in terms of where we are today. Now, a number of people have talked about the United States potentially releasing oil from the Strategic Petroleum Reserve, the SPR. And of course, this is one of those ridiculous things that the administration would be even considering. And, you know, this is not a political statement. This is just a matter of fact. This is like one of those things where it's got to be one of those borderline things that are right up there with the concept of asking OPEC to drill and produce more oil in order to lower the pump for US consumers at the gas pump, you know, the price. So, you know, if you really think about it, do we need to rely on OPEC to increase production in order for Americans to pay less for gas at the pump? What about asking your local producers, including all the Permian producers like Exxon, you know, ConocoPhillips, Oxy, etc.? This is crazy stuff. But anyway, I do not personally believe that we're going to see a release from the Strategic Oil Reserve. And even though this particular article I'm pointing to here is from the New York Times, I'm going to just take it at face value. And let's scroll down here to the bottom and say, what is the argument against the release? From a personal point of view, I don't think they should be released at all. Anything should be released from the reserve. Releases should be reserved for true emergencies. The reserve was established and designed to address emergency disruptions for wars and storms, not the periodic increase for prices at the pump in order to influence prices at the pump. When supplies are tight, prices naturally rise, and usually companies respond by producing more to solve the price issue, at least eventually. Would a release be effective? Absolutely not. Most experts believe that a release would lower prices modestly and at least for a short period of time. Is that really a strategic move? I mean, is that is that the best you can come up with if you're the administration of the United States of America? How much depends on how much is released and whether such action is coordinated with allies that could also release reserves like Germany and Japan. A release of, say, 30 million barrels would have no more than a temporary impact since oil prices are set globally and world consumption averages roughly 100 million barrels per day. That's where we are today. But let's dig just a little bit deeper and kind of see what's going on here. Russia and Saudi Arabia see oil oversupply in 2022. Now, when you see something like that, you got to say to yourself, like as an energy investor, we've been relying on the fact that there is significant demand and relatively speaking, not sufficient supply, right? So in other words, the curve is in our favor. And here you have two of the major oil producers and members of OPEC Plus saying they see oil oversupply in 2022. Everybody is predicting a surplus of energy starting from the first or the second quarter next year, Russian Energy Minister Pavel Sorokin told Bloomberg on the sidelines of this week's oil industry event in Abu Dhabi. Now, the first quarter or the second quarter is literally right around the corner. So we need to be aware of this as energy investors because you are going to be exposed to some risk in addition to the volatility we've seen over the past few weeks. The only question is when exactly that surplus will take place. But the difference is only a few months, according to Sorokin. Now, of course, much like the comment I just made about the strategic petroleum reserve, where I may or may not be correct, in this particular instance, Mr. Sorokin may also be correct or not. We don't know. It's not that he's guessing. He has much more information than what I do, but at the same time, time will tell. It's an important distinction because BP CEO Bernard Looney, for example, was also at ADIPEC, that's the conference, and he said he expects oil prices to remain robust for some time to come. Down here towards the bottom of the page, the event that they had at ADIPEC, well, let me just go up a little. According to Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, inventories could already begin to rise next month and into Q1 2020. Pay attention, guys. This is your investments we're talking about. Adding that this 400,000 barrels per day would be enough. We need not to panic, bin Salman said. We need to be calm. ADIPEC, the event that they recently held, the rare in-person oil and gas industry event, was also a platform for discussions about the COP26 outcome. What an epic failure that thing is, right? So you have a bunch of rich people flying private jets and sailing their private yachts in order to get together to decide how we should live our lives. But anyway, that's just my off-the-cuff remark in terms of COP26. Party time for the elite. OPEC Secretary General Mohammed Barkindo expressed his disappointment with the COP26 talks. Why? This is the first COP26 talks that targeted the oil and gas industry, yet didn't involve the industry in conversations about how to slow climate change. How can your whole discussion be about oil and gas and fossil fuels, and you invite nobody from the fossil fuel industry in order to contribute or give you some information related to what you're discussing? How about this one? The US oil shale patch is back in growth mode. Well, that's kind of a little bit of a surprise. The US shale production is finally beginning to grow again, with output set to climb next year due to increased spending in the Permian. The rise in output will be lower than in 2018 and 19 due to the newfound capital discipline of shale companies. Inflation and labor costs are two major problems US companies will have to deal with going forward. The government right now is in the mindset of not wanting to encourage people to work. In fact, they'd much rather want to give people money to stay at home. In other words, those people who are actually doing the work need to carry the burden of paying for the people who are not willing to work or unable to work for whatever reason, and whatever might be happening right now from a personal point of view, impacting their ability to work or not, which obviously is also related to the coronavirus and vaccinations and all that kind of stuff. Labor costs are two major problems US companies will have to deal with in addition. Down here towards the bottom, capital discipline is still key for the shale patch, but some majors have signaled in their Q3 earnings calls that they could add some more rigs in their Permian operations. ExxonMobil is an example of that. Chevron is an example of that. And BP Shale unit is another example of that. ConocoPhillips has also said it will boost activity in the Permian. And just earlier on today, I saw that Occidental was also looking at potentially looking to increase their production. So it'll be interesting to see where this one goes. But the fact of the matter is we still have WTI at around $80. We're halfway through the fourth quarter. And if we see a bit of increased production at these types of prices or higher, then the companies will end up making more money. How about this one? Russia's biggest move yet to take control of the European gas market. This is big news. Russia has managed to secure the largest share in Iran's huge Shale gas discovery, a move that could have huge economic and geopolitical consequences. A senior Russian official believes that this was the final act in securing control over the European energy market. Interesting stuff, huh? While Iran appears to have lost out economically on the deal, it will provide the Islamic Republic geopolitical support and the IRGC a nice slush fund. The deal finalized last week to develop Iran's multi-trillion-dollar new gas discovery, the Shale field, will see Russian companies hold the major share of it, followed by Chinese companies, and only then Iranian ones. So on this particular topic, all I want to say is this. I'm old enough to have lived through a whole variety of different types of sanctions imposed by the United States, much from the point of view of trying to either bully or otherwise manipulate people into some sense of compliance in terms of abiding by whatever the United States has to or wants to do. Now, in the past, what has happened is that sanctions, as a general rule, have been hopelessly ineffective. Yet the congressmen and women who pass these sanctions rules and laws and mandates and pat themselves on the back that they did a great thing are completely oblivious to the fact that the sanctions generally don't work. But what has happened now is a major shift, because previously, for instance, when I was younger, the United States was literally the only dominant superpower on the block. But that superpower status has been at least somewhat watered down by China's rapid growth over the past, let's say, 2 decades or so, if not more. But, you know, that was a certain comeuppance by China, where they are much stronger today. Russia is obviously significantly more powerful in the context of higher oil and gas prices, because that's where they make their revenue. And other growing economies like India have also started to flex their muscles a bit. So in addition to the fact that the sanctions are hopelessly ineffective, generally speaking, or as a general rule, you also now have some significant players stepping up and saying, well, you know, you're not going to tell us what to do. We're going to do what's good for our economy and what's good for our market. So it's an interesting thing, right? So the developments that have been happening sort of on a global scale in terms of where we are today impact us on in a variety of different ways. And we as investors need to be aware of this, right? So I'm not suggesting for a minute that you must now go and rush out and you know, sell your oil stocks. And I'm also not going to suggest for a minute that Bank of America is correct when they say oil, or WTI crude specifically, might be going to $120. It may or it may not happen. In fact, there's a really good possibility we might see $100 a barrel WTI soon. How soon? Maybe within the next couple of months or so. But then you have this interesting dynamic coming into play where countries like Russia say, and OPEC, for instance, Saudi Arabia specifically say, there's going to be an over demand as soon as Q1 or Q2 of 2022. So these are things that you need to be aware of. But at the same time, you also want to see, just in terms of where you're at, what the macro thesis is in terms of where you want to invest, what you want to invest in. And these are some of the things that we need to pay attention to and take a note of as energy investors. So guys, I don't have any advice for you. It's not my place to give you advice, because I don't know anything about your investment motivation or your objectives in terms of what it is that you want to reach. I just want you to be aware there's a lot of stuff going on. Take a few minutes every day just to sort of catch up with the news, read and see what's going on. Watch YouTube videos like this, and maybe there are people in addition to myself that will provide some information to you that could be useful. But take care and manage your investments to the best of your ability. And sometimes I say, manage your investments as if your lives depend on it, because in the instance of some people like myself, it does. So on that note, guys, stay strong, stay long if you are, trade carefully, take care, and I'll talk to you soon. Bye-bye.